Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE FinWiz powered by CNBC TV 18 Season 3. Today we are at the plant of one of Rajasthan's leading cement manufacturers, Wonder Cement.
Wonder Cement, part of the RK Marble Group, is a greenfield project in the Chittorgarh district of Rajasthan. The state-of-the-art project is built with cutting-edge technology and has marked its footprint in the burgeoning market of cement in the country within a short span of 3 years. NSE FinWiz visited the office of Wonder Cement in Chittorgarh with the country's finest experts to advise and educate the young employees on investments and financial planning.
And we're now joined by our two very special experts. We have Mr. Pankaj Mathpal, who's a certified financial planner and also the MD at Optima Money Managers. Welcome to the show, Pankaj. And we have Mehrab Irani, who's the GM at Tata Investment. Welcome to the show, Mehrab. And our core topic for today is retirement planning. So Mehrab, first question to you. Now, when you talk about retirement planning, and our audience is generally young, I mean 25, 35, no, I don't think anyone here, everyone's in that rough age group. Why should they be thinking about retirement today? I mean, even if you're 35, you've got 15, 20 years to go, 25 years to go. So why should they be thinking about retirement right now?
If we're talking about retirement planning, first let us understand what is retirement. Does retirement mean that after working for say 10, 20, 30 years, you attain say 58 or 60 years and the company says, okay, thank you very much for your service, you please don't come from tomorrow. I don't think that is retirement. And even when you retire, our needs don't retire.
Yeah.
We require food, we require clothing, we require all our regular normal services. In fact, we tend to or expect to enjoy more during our retirement years. So, according to me, retirement would not be retirement from job. It would be retirement from working for money.
Right.
Basically, as we know, there are two sources of money. We work for money and money works for us. So when we are a salaried employee or say when we are a small-time businessman or a profession, say a doctor, engineer, we are working for money. When I am using my time and energy for earning money, I am working for money. But when I send my money to work, whether I say buy some fixed deposits or bonds or debentures or invest in equity shares, I get dividends, or when I buy rental real estate, I get rent. So when I am investing my money, when I am buying investment assets, my money is working for me. So according to me, retirement planning would be to achieve financial freedom, to achieve that state when we stop working for money and money working for us. So I think whatever age we are, that is not important. I think everybody should strive to achieve retirement from working for money at the earliest. Because once we retire from working for money, we can then actually live our dreams and live a worry-free life and add value to our work and whatever we are doing.
Okay. Pankaj, Mehrab's got a very interesting point of view on this. But my thought is again, adding on to what Mehrab was also saying about, Mehrab was talking about, it can be done at any age. But then is there extra merit to do it at an earlier age rather than to wait till 40?
Yes, Sumit. Actually, retirement planning should be started immediately when you get your first salary check. The reason is this: because of inflation, the cost of living will increase by many folds by the time you retire. Second thing, the cost of delaying is, if suppose you want to accumulate 1 crore rupees in 20 years, say at 12%, you need to invest 10,000 rupees per month. But if you delay by 5 years, you have to invest double the amount. So that is why every 5-year delay will cost you double. That is why it is important that as soon as possible you start investing for retirement. Do you know, if suppose you are 30 years old today and wants to retire at the age of 60, how much money will you need? Depending on your expenses today, it will be something like 4 crore, 5 crore rupees. So you have to accumulate a big corpus. And for accumulating big corpus, you have to invest big amount. And if you delay it further, you have to invest bigger amount. So that is why if you start early, see, it does not make difference that how much you invest. More, what makes difference is for how longer duration do you invest or you remain invested. So that is why start as early as possible so that you'll have ease of achieving your goals.
Okay. Pankaj, this question is from Sandeep Kumar Patel. He says the return is very low in retirement plans. Is it worth investing? Is it better to invest in mutual fund SIPs rather than retirement plans? Maybe, this is a good point to, clarify some about retirement plans.
Exactly. There are two phases in life, accumulation phase and distribution phase. Accumulation, when you earn money, you invest some amount so that when you retire, whatever corpus you have accumulated, you get returns on that money to survive. So that is why it is not important that what product you buy. What is important that how much corpus you will need after retirement and how to accumulate that corpus. So based on your present expenses, whatever household expense, see your EMI, children, education, those things will be over by the time you retire. But your household expenses, your traveling expenses, medical expenses will remain even after retirement. So first thing, considering your present expenses and considering some inflation, say 7%, 7.5%, you calculate the future value of your present expenses. Say example, if you spend 25,000 rupees today, after 30 years, you will spend around 2 lakh rupees per month, considering inflation of 7%. And say as your age increases, the cost will increase further. If you spend 2 lakh rupees at the age of 60, at the age of 70, the cost will be much higher. So that is why, considering that fact, you have to accumulate some amount for retirement. For example, if by calculation that amount comes to 4 crore rupees, 5 crore rupees, now start the process of planning to accumulate that amount. So does not mean that you buy a plan which says XYZ retirement plan or pension plan. Now the objective is to accumulate that money, where you will invest in equity, direct equity or equity mutual funds. You will invest in other asset classes. So objective is to accumulate money, not to buy a plan. So that is why when you ask that the plan does not give good return, do not buy the plan. Because the plan which is named as a retirement plan will usually not give very good returns. So advice is that first calculate for your retirement corpus how much money will you need, and then start investing in different asset classes.
On that note, it's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE Fin Wiz, powered by CNBC TV 18 Season 3. Pankaj, we've been speaking about asset allocation. But can you simplify it for layman terms? What do these two words, asset allocation, diversification, what do these mean? And also there is a thumb rule which we talk about, that 100 minus a person's age, that should be the percentage invested in equities. So first part is, if you could talk about what is asset allocation, and then should we follow this thumb rule?
See, asset allocation means having various asset classes in your portfolio. At any point of time, you should have all equity, debt, commodity, means in India specifically we invest in gold, and real estate. Because the importance is that your portfolio should have growth potential, at the same time it should have stability. Now how much allocation? See, diversification, as we say, that one should not keep all the eggs in one basket. So that is why you should have all the asset classes, so that if equity does not perform, at least debt gives you some returns. If gold is performing well, you take advantage of that. At any point of time when market goes up, whether equity or gold, you feel it will go further up. When it comes down, you feel it will go further down. So that is why nobody is sure about that. It is only important that you should have all asset classes in your portfolio. As Sumit said, 100 minus your age should be your allocation in equity. See, this is a thumb rule. For the layman, because you don't know how much to invest, then you decide that 100 minus your age. Suppose if you're 30 years old, so 70% should be allocation in equity. But actually this is not totally correct, because a person who is 50 years old sometimes may take higher risk than the person who is 30 years old. Because in equity there is higher risk of volatility. Now suppose a person, he needs money only after 5 years. He is young, but he needs money after 5 years. And you know sometime in short term, market is volatile and there is higher risk. Now 50 years old person, he has 10 years time to achieve that goal. So in my views, though he is a 50 years old, but because he has longer duration to achieve his goal, so that is why he can take higher risk than the 30 years old person. So, or sometime what may happen even, the 30-year-old person may have more liabilities or responsibilities than the 50-year-old person. So every individual should see their risk appetite.
Okay.
And how much risk individually you can take. That is important. But yes, everybody should have proper allocation in different asset classes.
Mehrab, I want to talk to you about loans. Nowadays you get a loan for everything that you want. Even if you want to buy an iPhone 6s, there's a loan for that. How do you guide someone on what is a good loan, what is a bad loan?
Yeah, see, actually, loan is a very loosely used term. I think we should always borrow money or take loan to buy an asset and not a liability. And here, what does an asset mean? An asset means something which puts money in my pocket. For example, Sumit just mentioned about a car loan. So first of all, is car an asset? When you buy a car and you take out of the showroom, immediately it loses almost 20% of the value. Then you have to continuously incur charges on it, petrol or diesel, maintenance, driver salary, insurance, etc. So car is not an asset. Though in the balance sheet it comes under asset, but it's not an asset. It's a luxury which you buy to enjoy your life. So whenever you borrow money to buy a liability like a car, it is like a double whammy. On one part you are losing money on that liability, and on the other part you are paying interest. On the other hand, if you buy, say, if you take a loan, say, to buy a real estate,
or like an education loan,
or something, or even an education, which is for your future investment. So here you are creating value. In education, you are creating value in your own self. When you buy an asset, say a real estate or say an equity share, you are creating value in that investment. So I think you have to always try to create positive leverage, and positive leverage is that your return on your assets should generally be more than your cost of that loan. It is very difficult to do, but it's not impossible to do. All businessmen, all large companies actually strive to do that. So I think as an individual also we should strive to do that. So first rule is never borrow to buy a liability, and second is always borrow to buy an asset, and hopefully the return on the asset should be more than your cost of your loans.
I will be retiring after I'm 28 right now, so 30 years maybe, 32 years. And how is the idea of investing into government securities, government investments like PF, PPF, all that we usually invest? 30 years from now, because we have seen economies declining in European countries like anything. So will the government funds after 30 years in India will be as safe as they are right now?
See, investing in government securities can be a safe choice, but does not have potential to give you really good returns. And as you said that you have 30, 32 years for retirement, in such a long period, definitely equity will be the best asset class, or followed by real estate. So for long period, have some allocation in PF, PPF, but higher allocation should only be in equity, so that, as I said initially also, that you will need big amount for a retirement, which will not be possible to achieve with your investment in such small saving schemes or fixed deposit.
Please suggest what percentage of amount of our salary we should invest in SIP, and what kind of SIP will be better in future?
Regarding what amount of your salary, I think it should be at least a minimum of 20%. And the trick is that as you grow in your job and experience, your salary will also grow. But the saving actually has to grow at a higher percentage than the growth of your salary. Say for example, your salary is growing at 20%, let your saving grow at 30%. So that when you keep growing in your age also and in your job also, your savings also grow at a much higher rate. SIP is a mode of investment, and depending on your age, you should allocate between different asset classes within the SIP. So since just now you are young, you should allocate maximum towards equity and equity related funds, equity and balance funds. And as on when you start growing, you start maturing, you can invest some in gold also, and slowly into fixed assets securities also, which will give more stability towards your later years of your working life.
You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. It's time for a short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. Today we're at Wonder Cements in Udaipur. Mehrab, I want to talk to you about life insurance. Why, A, is it important? B, if it's important, how does a person decide what amount of insurance should they cover their life with? And what is, there's also this thing, you know, ULIPs or term plan or endowment. How do you guide them on what to do with that?
Yeah, I think life insurance is very, very important for anybody. The biggest mistake which I feel everybody does is that they mix investments with insurance. I would like to very clearly say that investments and insurance are totally separate. Investment is not supposed to provide us with insurance, and insurance are actually very, very bad fund managers. The amount of expenses which they charge and the underperformance which they do will generally not beat a regular equity or a debt product. So what I would suggest is that we should always go for pure insurance policy, which is term policy.
Okay.
So you and nowadays, a young person like you all will get even a 1 crore cover at a very few thousand rupees. You all will get even a 1 crore or a 2 crore cover. And the remaining money which you can save if you take an endowment policy, you will have to pay lakhs of rupees in premium for getting that same cover. So the remaining money which you save, you can actually productively invest in a proper asset allocation into equities and debt, which will give you over a medium term a much better insurance coverage, and also it will give you a better investment return also.
Security market provide fixed return percentage just like government securities provide कराती हैं. Just इस तरह से कोई सिक्योरिटी मार्केट में हमें फिक्स रिटर्न के मिनिमम 10% या 20% का हमें रिटर्न मिनिमम मिल ही जाएगा. इस तरह से कोई सिक्योरिटी मार्केट में फैसिलिटीज है क्या?
We are expecting safety as well as returns. And returns also means high returns. That is not possible. See, if the asset is safe, it provides you 7-8% return. So if you are expecting 20% return, that will not be possible for government securities. Then you have to invest in equity or real estate where you can expect higher returns. Guaranteed returns will never offer you 20% kind of returns at this point of time.
As a layman, my question is to the we have to invest in a equity market or a commodity market. The commodity market gives a higher return, but has a lower than security. So we have to invest in commodity or equity.
Okay, fine.
As we have been stressing, we have to go on a proper asset allocation plan, and that will depend on your age, your income levels, your goal, your risk-taking appetite. So as you are young, I think you should allocate more towards equities. Investing in commodities is never very easy. And the options of investing in commodities also for a common investor are very limited. Besides maybe gold or silver, it's generally very limited, and the knowledge is also very limited. And those are anyway inflation hedges. It may protect you against inflation, but it will not generate growth capital for you, which will come only from equities. So I think you have to do proper asset allocation, and in your initial years always allocate more towards equity and maybe some amount towards commodity and fixed income as well.
What are the risk factors we should consider while taking any of the SIPs or assets or commodity side?
There are different kinds of risk, like credit risk. If you do a fixed deposit, if you open a fixed deposit and that company, if it's a company fixed deposit, they do not return your money. You buy a bond and company is unable to meet the obligation. That is credit risk. There is reinvestment risk. If suppose you are planning for some goal where you are thinking that you will invest your money at 10% forever, but the maturity is 5 years. After 5 years, when you want to reinvest that money, the rate of interest is only 7%. So that is another risk. There is volatility. That is also risk. So there are different kind of risks, and believe me, there is no asset class, there is no product which comes without risk. One or other kind of risk will be there. So, for example, if you say in equity, there is risk that market goes up, market comes down, which is not in fixed deposit. But fixed deposit, when you want to reinvest, that time market is down and you cannot invest at the same rate. So that is another risk. So that is why risk will be there, but what kind of risk you are comfortable? For example, you are comfortable at 8% and your time horizon is only 5 years. So you lock your money in a fixed deposit which is offering you 8% for 5 years can be a good choice. But if you are a long-term investor, then I don't think that fixed deposit will be the right choice, because you may not get chance to invest at that same rate as you invest now.
Well, that's all the time that we have on the show. Thank you so much, Pankaj, for coming on the show. Thank you, Mehrab. Thank you so much for having us here.
the show gives a very good insight about retirement. Normally at this age, people don't think about retirement. People normally spend most of their money, but it was very good to hear how we should plan as early as possible. It gives an edge, especially for younger people like us. Apart from that, a lot of myth about insurance as well as investment got clear. People normally confuse investment with insurance and insurance with investment.
I think that show was very amazing, and it was a great opportunity for youngsters like us. In our first year of career, we can plan our retirement, and we can also invest 20% of our income into savings and make good out of it.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But before we go, here's a chance for you to win a cool goodie bag by answering this viewer question.
A systematic investment plan, or SIP, averages out the cost of investing and helps benefit from the power of compounding. A. True. B. False. Send in your answers at fwq@network18online.com. The answer to last week's viewer question is option 3, Equity Growth Fund. Thanks to all the viewers who sent in their replies. The winner for episode 17's viewer question is Sundara Lakshmi.
We'll see you next week with another set of young employees at another company. Until then, from the entire team, many thanks for watching.
Focus. Ideate. Innovate. Enable.